How to build a 5-year retirement plan in 10 minutes. Most people wait too long to plan for retirement, thinking they have plenty of time, until suddenly they don't. The truth is, the last 5 years before retirement are the most critical years of your financial life. Decisions you make now will determine whether you retire comfortably or spend your golden years worrying about money. Here's the good news. You don't need a complicated 100-page financial plan. In this video, I'm going to walk you through a simple, effective 5-year retirement plan. The exact framework I've used to help clients transition into retirement with clarity and confidence. This isn't just about saving money, it's about setting yourself up to retire stress-free while paying as little in taxes as possible. Hi, if you're new here, my name is Joshua Bliss, founder of Gateway Capital Management under Balboa Wealth Partners. I've spent the last 19 years helping clients build, preserve, and optimize their wealth, ensuring they retire with security and financial freedom. If you're retiring in the next 5 years or even thinking about retirement, this plan is for you. Step 1, define your retirement vision, year 1. Before you start crunching numbers, you need to ask yourself, what does my ideal retirement look like? Where do I want to live? What will my daily routine be? How much will I need to maintain my lifestyle? Too many people retire without a clear plan, and that's why they end up either spending too much early on or living in constant fear of running out of money. Let's break it down. Imagine you want to travel frequently, live near family, and maintain a comfortable lifestyle. That means you need to factor in 1, housing costs. Will you downsize, keep your home, move to a lower tax state? Number 2, healthcare expenses. Medicare isn't free, and long-term care costs can be massive. 3, day-to-day living expenses, such as groceries, transportation, dining, entertainment. Most retirees underestimate inflation. A $5,000 monthly budget today won't cover the same expenses 10 years from now. Once you define your ideal retirement lifestyle, you need a number. This is your target annual spending. For most people, this falls between 70 to 90% of their pre-retirement income. If you're making $100,000 per year, you'll likely need $70,000 to $90,000 per year in retirement. Once you have this number, everything else in your plan revolves around funding it. Step 2, assess your current financial position. Now that you know what you need, let's figure out where you are right now. Gather your financial details, such as retirement accounts, like your 401k, IRA, Roth IRA, and pensions. Also your investment accounts, brokerage accounts, real estate, business holdings. What about cash savings and emergency funds? What about your debt, mortgage, credit cards, loans, and information about expected Social Security or pension income? Once you have everything on paper, it's time for a simple equation. Total retirement savings divided by 25 equals safe annual withdrawal. This is based on the 4% rule, common guideline that suggests that you can withdraw 4% of your portfolio each year without running out of money. For example, if you have $1 million saved, that gives you $40,000 per year before adding Social Security or other income. If your goal is $80,000 per year, but your savings only generate $40,000, you now know exactly how much more you need to save or how much you need to adjust your expectations. Step 3, optimize your tax and withdrawal strategy. One of the biggest mistakes retirees make is ignoring taxes. Just because you saved $1 million doesn't mean you actually have $1 million to spend. If all your money is in a traditional 401k or an IRA, every withdrawal is fully taxable, which means you could lose 25 to 40% to taxes, depending on your tax bracket. But if you strategically convert some of that money into a Roth IRA before retirement, you can reduce your future tax bill significantly. Here's a smart tax strategy in the 5 years leading up to retirement. 1, take advantage of Roth conversions. Convert portions of your pre-tax accounts into a Roth IRA during low-income years to lock in lower tax rates. 2, plan for required minimum distributions, also known as RMDs. At age 73, you'll be forced to withdraw from your traditional IRAs and 401ks, even if you don't want to. If you haven't planned for this, you could get hit with a higher tax bill than expected. 3, use tax-efficient withdrawal strategies. Withdraw from taxable accounts first, such as your brokerage accounts. Then tap tax-deferred accounts, 401ks and IRAs. Save Roth IRA withdrawals for very last, since they're tax-free. By structuring withdrawals strategically, you can extend the life of your portfolio by years. Step 4, eliminate high-interest debt and build cash reserves. Retirement is not the time to carry high-interest debt. Before you retire, your goal should be to eliminate all non-mortgage debt, including credit cards. Even a $5,000 balance at 20% interest costs you $1,000 per year in wasted money. Car loans, if possible, pay off your vehicle before retirement. Personal loans, interest payments erode retirement savings faster than you think. At the same time, you should build a cash reserve of 1 to 2 years worth of expenses. Why? Because if the stock market crashes in your first few years of retirement, you don't want to be forced to sell investments at a loss. Step 5, run your retirement plan through a stress test. You now have a clear retirement vision, a full picture of your financial situation, a tax-efficient withdrawal strategy, and debt-free status with a solid cash reserve. But before you retire, you need to stress test your plan. Ask yourself, what happens if I live 10 years longer than expected? What if inflation is higher than projected? What if the market crashes in my first few years of retirement? What happens if I have a major health crisis? The best way to prepare is by running multiple financial scenarios. If your plan only works under perfect conditions, it's not strong enough. One way to protect yourself is by considering the following. First, long-term care insurance. 70% of retirees will need some form of long-term care, which can cost $100,000 or more per year. 2, a diversified portfolio. Your investments should be balanced between stocks, bonds, and cash to weather market volatility. And 3, part-time income options. Even working a few hours per week can extend your portfolio's lifespan by years. Building a 5-year retirement plan doesn't have to be complicated, but you need to start now. If you want a custom retirement roadmap tailored to your finances, book a call with me using the link in the description below. We'll walk through your numbers, tax strategy, and investment plan to ensure you retire with confidence. And let me know in the comments, what's your biggest retirement concern right now?